It's a special day for us and we have a special guest. When I say special, I'm talking about Prashant Jain. Over the years I've interacted with him, there is one thing which has been constant is his original thinking. The fact that he always thinks away from the crowd, he never likes to buy fashionable stocks, always believe in the whole tenets of value investing is quite extraordinary. Prashant has been a big supporter of 80 now. Every time we've requested him, he's always been very he's always been very charitable with his time, and today we have him on this very special day as we celebrate our 16th anniversary. And I was looking at old footage, Mr. Jain, with little bit of reducing hairline and a white mustache, nothing has changed for you.
Again, you look the same. You look younger. I look older. Older. That's what has changed in 16 years, right?
But markets are looking fitter and markets are looking better. I mean, that is the reality in last 16 years, that all you had to do is just keep the faith. In last 16 years, the magic has happened.
That's always the case in equities. It's always a game of right understanding, discipline, and lots of patience. And in a growing economy, the more patient you are, the more wealth is created. So, I mean, multiple people have said this in multiple ways, but yes, what you are saying is absolutely right.
Last 16 years, we've seen emergence of mega trends. Jam Trinity, Startup Mahakumbh, financial inclusion, big comeback in themes like Made in India. What do you think could influence the script of not next 16 years, but next 3 to 5 years now?
I think this is a market that is probably the most fairly valued market that I have seen in my entire career, not just in aggregate terms, but even across sectors. The dispersion in valuations has really come down. I mean, 5 years back, retail banks were five time price to book, corporate banks were 0.2 to half time price to book. They have converged between two and a half times. FMCG stocks were 70, 80 PE, utilities were, or defense companies were 3, 4, 5, 7 PE. They've all both come around to 15 to 40 odd times. So this is a market which has little room for multiples to move up. And I think even across sectors, the under and overvaluation is one of the lowest I have seen. I think this is a classic compounding market. And one more thing which has changed, which all investors should take note of, that while the real growth in India continues to slowly tick up, inflation has come down really sharply. As a result, our nominal GDP growth is now growing in around 10, 11%. And margins are fairly healthy across sectors. So, I mean, barring isolated companies, we don't see too much room for margins improvement. So at a very broad level, I feel the profitability should track, profit growth should track nominal GDP growth around 10, 12%. And you saw it a few days back that even bank credit growth has slowed down to 9 odd percent. So aligning with nominal GDP, IT is growing slower, consumer companies are growing in single digits. So I think this is a market where Nifty should compound in low double digits over next 5, 10 years, and not much to choose across sectors. I think that 10, 12% compounding is extremely valuable if you put it in the context of extremely low inflation and low cost of capital. The gap between India and US interest rates is now sub 2%. It is the lowest by a margin that we have ever experienced. For almost my entire career, this number used to be between 4 to 8%, and now it is sub 2%. So I think we have to be prepared for healthy real returns, but sharply lower nominal returns. So that is what I thought, how I look at these markets. Yes.
Oh, understandable, Prashant. And, which is why I guess we have such an aggressive central bank as well, with all the norms and rules getting announced off late. But other than that, when it comes to stock selection, what you spoke about was at an index level compounding, what kind of return should one anticipate? But you can beat that by being in the right stocks. Do you think there are growth opportunities and along with that, some valuation comfort in the market in some sectors, perhaps?
See, I think, as I said, I mean, some dispersion is of course there, but it is sharply lower compared to the past. Having said that, I feel consumer discretionary and capital spending should continue to grow faster than nominal GDP. Consumer staples and tech IT, especially the large companies, should grow much slower. But this is about growth in businesses, growth in profits. But the valuations seem to be discounting most of what I say. So the stocks outperforming just because profits are growing higher need not be the case. When I still feel on the margin, banks look a little better, utilities look a little better, the consumer discretionary looks all right to me. Pharmaceuticals based on individual companies is promising. And what we are underweight is basically consumer staples and large IT.
Mr. Jain, while we can talk about the big picture, which is inflation is low, the nominal GDP is 10 to 11%, which means projected returns for the index should be in that range. But with this kind of an GDP growth on this kind of an base, which is $4 trillion, there are a lot of new themes and sectors which will get created. For example, the success story of last 30 years has been manufacturing, defense, startup, digital. So which are some of those new themes which will propel this 10-11% GDP, the 10 to 11% nominal GDP higher?
You are right. When some themes will grow faster, of course. I mean, Make in India is a very powerful theme, but you would recollect it has been talked about, discussed for many, many years. And defense is, of course, a very powerful theme. We have discussed it on multiple occasions in the past. So these themes will definitely grow. Digital businesses is a very powerful theme. They will continue to outpace the GDP growth by a wide margin. The only challenge is that these appear to be reasonably fairly valued, in some cases even overvalued. And for example, while I mean, look at the price movement of defense companies, they're up 10 to 15x. So the multiples are not cheap. Of course, growth is there. So the key is that is the growth mispriced? And I see very little areas where companies with a promise of faster growth are mispriced. So that is why one has to be a little cautious. I mean, there have been multiple occasions in the past uh, when companies have done exceedingly well, but stocks have done nothing even over 10, 20 years because the growth was overestimated, over discounted by the market. So I don't think there are any low hanging fruit, in my opinion, in these markets.
Okay. Mr. Jain, I go back to the whole thesis and the template which you follow, which is value investing. Buy something which is trading below its intrinsic value. For example, it was largely PSU banks couple of years ago, then it was Power. Anything else which at this current juncture fits into your bracket of value investing?
Nikunj, I wish it was the case. But as I said, this is one of the most perfect markets that I have seen in my entire career, both in terms of aggregate multiples and multiples across sectors. So I'm sure there will be few companies, maybe many companies, which will in the end outperform. But I don't think, at least I am able to spot these right now. And I also don't think these will be individual companies, they need not fit a theme because look at last 5 years. See, pre-COVID, maybe there were 3 crore demat accounts. Today, there are 13 or 15 crore demat accounts. So this has been a narrative-driven market. And most of these are first time investors, and the narrative, by the way, is correct and it is very logical. And that's why these narratives have got probably fully or over or discounted. That is why I feel it will be a market where one can try and outperform the markets by individual bottom up picks and not through any theme based investing. At least that is my view. Of course, uh, one could be wrong, and some theme may actually outperform significantly even from here. Yes.
There are two themes, since you use the word narrative, they just pop up on my mind. One is EV, and second is solar or energy transition. Now these are powerful themes, and perhaps for next decade, who knows, they would be the real deal, both EV and energy transition. But for investors right now, have these stocks become Humpty Dumpty?
So, Nikunj, to be honest, I mean, we could again be wrong, but at least we have not participated in these themes because we think so. We think over time the incumbent ICE companies will come back. They will play a strong catch up on products, and they will give a very tough competition to the pure play EV companies. And because there are significant advantages that these incumbents have of size, scale, manufacturing, mature organizations, distribution, mother brand, service network, so many things. So we think while ED adoption will grow for sure, and EVs as a industry category will grow, but one has to be careful if you are just investing on the basis of that theme, because it can be even more competitive this business than even the ICE, the traditional companies, because after decades of competition, there the market shares have stabilized, margins have stabilized, but this is an emerging area, and there here the tendency to do a land grab will be far more, and much bigger balance sheets will vie for creating a leading position. Otherwise, their entire business is at risk. So I think this, in spite of growth in this space, it need not be rewarding for investors, at least in a general sense. And I think similar are my thoughts on the solar or the renewable energy space. This It's very tough to create sustainable competitive advantages in these businesses. Ultimately, these are products which the whole world makes, understands, and very hard to create some competitive advantage. And in many cases, these businesses are resting or their prospects are significantly impacted by government policy. What do you allow to be imported? And not just in India, but even outside India companies, how do they allow, at what custom duties, etc., what restrictions do they allow Chinese imports? So I think these are, it is hard to guess the long-term outcomes of these businesses. Besides, even within the country, and that is clearly the government's intent, that your capacities at different stages should scale up very significantly. And the moment you hit an overcapacity, it is the margins can come off really sharply. So that's why we have not participated in that space again. I must, however, add that people like me, we tend to make two types of mistakes: mistakes of omission and mistakes of commission. So we believe that wherever we are not convinced we see risk, we try and avoid that space. That space may create wealth, we could be wrong, but we are not comfortable with that risk. And those set of mistakes are okay for us. What we are more perturbed about, more careful about, is not to make mistakes of commission. That what we buy, we should not lose money or underperform on that. So why I said this is because while we have not invested in the EV and the RE space, our view may be wrong and they may indeed create sustainable winning businesses. Yes.
Very interesting insights there, Prashant. The other thing I also wanted to talk about was the consumption space, Prashant, because that's where you're seeing the big changes happening pretty much on a daily basis. The entire face of consumption has changed perhaps in the last, 5 to 10 years. Any opportunities there, you think?
You are right, absolutely, and I am also surprised by the pace at which the consumer is changing. And I think not just in terms of the product basket, which is shifting more towards experiences, looking good, feeling good, etc. So I think there's a lot of change taking place there, and it is showing up in the numbers also. On the other hand, the traditional moats, competitive advantages of the dominant consumer-oriented companies like scale to spend on mass media, uh, the access to talent, the distribution, the hugely complex it was with the coming of e-commerce, social media. I think those barriers are being reduced. The consumer is far more experimental today, and people want to try new things in every aspect of life. So I think this is a very fast changing consumer space, both in terms of categories, consumer habits, emergence of new businesses. So I think one again has to be careful, and I, for one, while there is growth in this space, the multiples are actually quite rich. But I think still this is a good space because consumer discretionary consumption should continue to grow. And wherever you find businesses that have some competitive advantages, we would like to participate in that. But it is, I think, the old way of thinking, making money that just buy these large, dominant companies. I think that seems to be undergoing a slow but sure change. Yes.
Prashant, lastly, will the faith in equities remain for the years to come? And will capital markets, the entire ecosystem of the listed plays within that, continue to make money for investors or not?
No, I think absolutely, absolutely. I mean, so India is by far the fastest growing economy, and not just fastest growing, it is growing with the least amount of volatility. So India's volatility of growth is one of the lowest in the world, and that is simply because we have very little exposure to export of goods and commodities, which are more cyclical than other parts of the economy. Our macro fundamentals are probably one of the strongest that I have seen. Our current account deficit, I think, will surprise us on the downside. Rising service exports, rising remittances, lower oil prices despite the wars create this situation. Government is steadily bringing down fiscal deficit, and low oil prices is also supportive of lower fiscal. So I think India has great macros, absolutely. Only thing is our return expectations in nominal terms have to be realistic, and faster real growth does not mean 15-20% kind of returns. You still, your anchor, your expectation should be anchored around nominal GDP growth. And last thing, one significant change we are seeing. I mean, we have of course seen the change of the local flows playing a far bigger role than the foreign flows. So our volatility of markets has gone down considerably, so which is great. But one new change what we are seeing is the massive supply of capital. Now, promoters want to sell, Ps want to sell, and at the slightest of uptick in the markets, the supply that hits the market is really very, very large. So I think while flow of money towards mutual funds is large, but so is the supply of capital, and I think that will ensure in a way that excesses do not take place, which in a way is good for all long-term investors as
Prashant, you are a big votary of market cycles, and the biggest truism in the market is mean reversion, and parallels can be drawn between current market and market cycles in the past. So, if you have to draw a parallel of 2025 versus few market cycles in last 20 years or in last 15 years, what does this market remind you of, and what does this market looking like?
So, Nikunj, one, as I said, there is nothing which is terribly under or overvalued. If I were to draw an analogy, and I'm thinking as we speak, I think what was overvalued is coming down. It is like one side, one bar of the X, and something that was undervalued is moved up sharply. And I think both seem to have converged towards fair multiple levels. I don't think markets will remain like this for long because markets will ultimately overvalue, undervalue things. But right now, excesses at both the ends seem to have come down. There has been a strong mean reversion across markets. And of course, I look forward to some mispricing in the markets because that is what active investors like me actively seek. But for now, in my limited wisdom, I am not able to see meaningful mispricing across any meaningful sectors in the market.
And, and finally, before we wrap, I just wanted to wrap it up with the whole definition of defensives. You know, in last 15, 16 years, we've used the word defensives a lot. First it was for IT, then it was for pharma, now it's for consumer. So looking at the current regime of interest rates, inflation and valuations, what is the new defensive in this market?
So I think the that definition of defensives was appropriate because that time all the economic sensitive businesses, the capex, the banks, they were suffering. So they were seeing a fast erosion in profitability, and that is why these businesses, the right word was defensive. It was appropriate, but I think things have changed a lot. Profitability is healthy across sectors. We don't see much risks to that. But I mean, if in a strict sense, if you say if markets fall, what will fall less, hence it is defensive, then I think large caps fit that bill well. Now, in aggregate terms, I feel large caps are offering better value. Value was beginning to emerge in small caps a few weeks back, few months back, post the sharp correction. But we have seen a very sharp rally in that space. So once again, I feel should there be a downside, large caps will prove to be more defensive. One final point is small caps, the number of companies is so large that you will always, someone should be able to spot few companies here and there, which may significantly outperform. But small caps as an aggregate, mid caps as an aggregate, I think looks less attractive than large caps for now.
Okay, Prashant, so good having you today, and thank you for accommodating our request and joining us today on our very special day.
Oh, thank you. Thank you. Welcome. Bye.